According to the Moody's Investor Services, the combined impact of border closures and measures to contain the spread of coronavirus, as well as the supply chain disruptions, will weigh on almost all sectors of Kenya's economy. The UK-based rating agency says it expects Kenya's real GDP growth to slow to 1% in 2020 from 5.4% in 2019, while below the 5-year average of 5.6%. Lower growth combined with recently announced tax measures and increased spending will result in the government's fiscal deficit widening to 8.5% of GDP in the fiscal year 2019-2020 and 9.1% of GDP in the fiscal year 2020-21. The National Treasury says revenue collection is lagging behind by more than 500 billion shillings 1 month before the end of the fiscal year 2019-2020. Due to these fiscal shocks, Moody's has today changed the outlook on the government of Kenya's ratings to negative from stable. Concurrently, the rating agency has affirmed Kenya's B2 issuer and senior unsecured ratings. Experts predict the shock to growth and larger fiscal deficit as a result of the coronavirus outbreak worsen Kenya's already high and increased debt and interest burdens. Weaker growth and larger fiscal deficits will further aggravate Kenya's already high debt and interest burden, since most lenders use the rating agencies to price borrowers. Regina Manyara Gitan reporting for Channel 1 Business.